All right, guys, we are Tuesday, the 6th of February, 2024. And we're just a little late here with the weekly look ahead as we did have a bank holiday for St. Bridget's Day here in Ireland yesterday. Pretty quiet week, really looking ahead here. Quiet day today, Tuesday. Some interesting stuff going on in the background though. Let's get the squawk off and let's jump into what we want to cover this week. Yeah, looking ahead, really not too much going on. We've had Fed's Jerome Powell speaking Sunday there in the US, and he's saying essentially it might only be like three cuts this year, 3 to 4 cuts this year. So that's kind of interesting. As we roll forward, it's going to really put a lot more pressure on these buyers as we come into further FOMCs along through the timeline. Services PMIs yesterday, 52.5, miss on 52.9. Prior was not revised at 51.4, and ISM non-manufacturing 53.4, beat on 52, prior revised down to 50.5. Crude oil tomorrow, Wednesday, as per usual. Thursday, initial jobless claims out of the US, 219,000 expected, below prior 224. And then Friday, the highlight is going to be German CPI. So a bit of a dead duck of a week as we look to go into spring here. But let's have a look at where we are pricing rate probabilities here. And so you're seeing in March, we're still looking at a 16.5% pricing in here of a cut, and it's just not happening. So the market, this sort of speaks to how equities are a little bit still overpriced here. However, it's not happening. And so that's why I just think, yeah, we still have to keep moving up on equities here because this economy is hot, and I think we should be buyer because things are good in the US. But as we look through to May, all of these rate cut trajectory percentiles are cut down now, but still looking at May for a cut there. And then it gets looks for 2 cuts by June. But I don't want to get too dragged into this. I will post a link to this on the descriptions. All right, here we go. Looking at what's going on in Asia at the moment, and the China stocks rebounding today. We're going to cut to a chart of that in a second, but all in all, this is a China composite index we're going to look at in a second, but a lot of the stocks in China have been really beaten up over the past couple of days, essentially because they are kind of more recently coming out of a lockdown situation and trying to kickstart that economy back to work and sort of, it's where the S&P and the US economy was like over a year and a half ago now. And so a lot of these stocks got really severely sold down and halted actually yesterday when we went to open on the Europe. By the time we opened up on Europe yesterday, a lot of this selling had come into the Chinese markets. Today, what we're seeing is a bid up out of there. Now, one of the reasons why we've been sold down on China stocks is essentially, number one, I think there's a ton of liquidity, people trying to buy those dips there on China stocks, and they're just providing liquidity for more people to exit. And the main reason, though, is that these economies are, the economy in China is just really beaten up from the lockdowns. They're going to have to try and get people back to work, back into factories, back into offices. And we're seeing so far from the European and the US economies, more developed economies in the Western world, is that working from home is here to stay, right? And so obviously as well, the real estate sector in China really, really, really beaten up. A couple of the large property names and developers there also going to the wall. So there's a lot to be feeding into the downside here. However, today, and these are monthly bars here. So you can see if we go to daily bars, you see we've been really sold down probably since the 29th of January overall in this massive downtrend. But today we are up, currently up 3.48% on this index here. But if we switch back to the monthly bars, it's just really beaten up here, really beaten up to the downside. And is the bottom in? I don't think so. So a couple of measures have come out from the finance ministers out there essentially looking to try and support these markets and talk about how that the government will stand again, with the economy. But what you're seeing here, I thought this is a really interesting chart from Zero Hedge talking about, how these markets are taking a bid up today and coming out of the lows. But I thought this was really interesting to see the number of strikes, labor strikes in China at the moment. And you see just this massive rise through basically all of 2023, just this massive block into new all-time highs. I thought that was really interesting just to speak to the general civil unrest in China. All right, moving on here. Looking at household debt, mainly is at fixed rates, right? And so if we kind of try and zoom in here to see that, essentially, a lot of the bears would kind of talk about how these variable rate debt instruments in the household sector are going to crush middle income earners and normal households. But you're seeing everything is at a fixed rate. 71% of household and US consumer debt is fixed. So that's mortgage, student, auto loans fixed at 71%. Now, if you're taking out a loan tomorrow or today, you're going to be fixed at a higher rate. But before we kind of came into these higher rates, which would have been on anything from a 2-year term to a 30-year term to maybe a 40-year term, you wouldn't have had these higher rates. So the harem scarum of how these higher rates are just going to be a complete headwind to US households is probably a little overcooked. So I'll post a link to this from Apollo Academy in the description below. Also, a nice, interesting chart from work from home being here to stay. And this is really just looking at North America, but you're seeing a general rise in sustained levels here on the work from home chart, and I think this isn't new to anyone, but I think a lot of people who have skin in the game in terms of owning or having medium to long-term leases on offices will be saying, no, this is just a fad. People are going to get back to work. We're going to force them to get back to work. Well, I don't think so. It's not happening. Anyway, look, it's a slow news week. And, I just thought I'd just mark everyone's cards here about what we're really seeing coming through as the future. This is the future we're living in right now. This is the future we're living in. So you're not on your phone anymore. You're just in a totally immersed new world while you're having lunch or dinner with your mates here. I saw one picture of a guy, in his Tesla. Tesla was auto driving, and he was plugged into his Apple headset. So, yeah, we're all pretty much close to Skynet now and the demise of society. All right. Moving on to where these tax dollars in the US are going. Well, it turns out an audit on Ukrainian weapons finds that $1 billion worth are missing of the latest tranche of $1.7 billion worth. Okay, so that is not good. So and we kind of knew this was going on, but the Americans still want to send more and more and more financing, and in the way of weapons and cash and I don't know, whatever, cheeseburgers. I don't know what they're sending over there, but it's going missing, and no one's surprised. All right, so I'll post a link to this. All right, okay. So let's get over and have a look at some of these charts and see what we can see. And so we get over into, we're just really going to keep this short and sweet because I don't think there's too much to report on here. But essentially, talking about last week, where were we last week? Sunday, Monday. So yeah, I was looking at us getting up into this 50-31s half for the S&P, which is the back adjusted all-time high. And we did indeed come back over that 49.54s we've been looking at, and essentially closing above there on Thursday and Friday to finish out the week. And so is the market going to use this as a springboard, 49.54s, to get up into what will be 50-31s and a new high, I would reckon there. I think so. And it's a big level to be looking at this week, long above, short below. If we do manage to find ourselves within this session, and I don't think it'll be this session, but maybe 49.98 quarters, I think there will be a little bit of liquidation into that, but not enough for us to, come way back down here. So look, the bulls are in control. You're just looking at that level there in a 30-minute on the S&P, 49.54 is quarter. Springboks, bang, up we go. Speaking of Springboks, I hope everyone has Ireland backed to win the Six Nations World, or Six Nations, I was about to say World Cup there for some reason, but I'm just lamenting a lost bet there for me. All right. Yeah, again here, let's see on the Dow, what was I looking at last week? Yeah, we were above, would have been looking at these levels, 38,280s, generally came in as support then and sprang us up into that new high there for the Dow. I think ultimately support buyers came in yesterday, Monday, 38,355s on our A period here in Duggan Capital. And I think that's going to be buyers to lift this a bit higher. But there's some trends coming in here to just note if we break. But ultimately, I wouldn't get too excited about a long or medium term short at the moment. We just don't have the catalyst for that. The economy's hot, the market's hot. We should be supported. Oil. Let's look at oil here. I mean, look, really nice trend coming in. Seasonally, we like, some 6-month spreads on this. June deck, June, September, obviously that shorter spread. But I think net, we should be moving to the upside here. Nice little doji there yesterday. Very difficult conditions on Friday to kind of pick a bottom there. And that's kind of what you're trying to do. But this 7160s, we were banging on and on and on about this one in the room last week, and again it was just really hard to get that trade. Didn't get it myself, and we did get a little bit of it on Friday, but then the market just stalled and didn't pick up, and then we flushed out of it. We didn't. We only got the 7193s on Friday, and then we got 7160s yesterday. Big buying coming out of there. If you see that there yesterday, just kind of slip below, and then big amount of buying coming in. That was, I think that was Ollie in Duggan Capital doing that one. So I like the longs on oil for sure. Gold, I like the longs technically on gold. I mean, fundamentally, I don't think it makes sense, but I know what I like when I'm looking at a technical chart. If we can hold the 2039s, I think we're going to cruise basically from here on up on gold over the coming week to 2 weeks here on gold. And I don't know what the catalyst driver for that would be, but if these technicals are to hold up, something is going to come in. Obviously, the risk is below, just below there, the 2039s. I'd say about 2038s, man. It doesn't have to be that much bigger. 2038s even, but 2056 is, I think, the immediate target to the upside here, which is a sort of historical level, but really the meaningful one is 2063s to liquidate some of those longs and then hold your runners for upsides. All right, that is it for me for another week ahead. Hope everyone has a good week, and keep your wrists tight and stay lucky. Cheers.